Market is in a holding pattern here as investors wait on that CPI report and the Fed decision. But our next guest says the real catalyst for stocks in the new year will be tax cuts. Joining us now is Jay Hatfield, Infrastructure Capital Advisors CEO and CIO. Jay, always good to see you.
Thanks, Josh. Thanks, Joey. Great to be on.
So you raise your 2025 year-end target for the S&P. You go to 7,000, Jay, and that's after that red sweep we saw on election day. Walk us through why.
Well, it's really just arithmetic. So cutting corporate taxes is great for corporations. Not very insightful, but it's true. And it's also good for earnings growth of corporations because their growth is determined by their after-tax return on capital. So a lot of strategists come on and say, oh, well, I don't think earnings are going to grow 10%. Well, they normally grow 10% because if you retain 70% of your earnings invested at 15% after tax, that's 10. So it's built into the market, but if you lower that tax rate, then the growth rate goes up and earnings go up. And so if it weren't for a corporate tax cut, which we don't know yet, that bill is going to be problematic, we would just be in line with the street. The street's coming out 65, 6,600. That's where we would lower our target. So we'll be dynamic during the year like we were this year. We raised our target to 6,000 in June, which is working nearly perfectly. Even at the end of the year, it seems to be kind of coming back to 6,000.
So there is still the if around the tax cuts though, right? So it seems as though most investors are assuming the existing tax cuts are at least going to get extended. We definitely have talked to some people who say, well, we don't know if we're going to get a cut beyond that. So how do you sort of game that out at this point?
Well, we originally had thought about a 7,500 target. So that's the 15% magical rate that gets thrown out there with some caveats, like you have to be a domestic company or something. But we think it's going to be difficult to get this bill passed. You know, it's reconciliation, which requires a balanced budget over 10 years, which you can play a lot of games with. But also, this Congress, at least a portion of this Congress, is pretty worried about the deficit. So it's not going to be just an open book. So that is the big uncertainty of the year. And we think it's more important investors focus on that than tariffs or deportations or the latest nomination or other distractors. Just focus on this critical element, which is corporate taxes.
But you must get questions, I'm guessing, Jay, from clients when they ask you about tariffs. Well, are you in the camp that, listen, it's a negotiating tactic?
Well, that's part of it, but what everybody ignores, because this is a little bit of a talking point left over from the election, and a lot of the economists that are writing about this are Democrats, like Alan Blinder in the Journal. But what everybody ignores is you get proceeds from the tax. It's basically a partial VAT. So that's good for long-term growth and investment because you have a lower budget deficit or gives you firepower to cut corporate taxes. So it's actually, in the long run, a positive thing, and it doesn't really increase inflation from a technical perspective. Inflation is ongoing increases, which only really comes from the monetary sector, from increasing the money supply. It's a one-time hit, and that is going to show up a little bit in CPI, and it's not great for some consumers, to be fair. I'm not the biggest advocate of it, but I think everybody's missing that there's a long-term effect that's positive. Like if Trump came out and said we're going to have a 15% VAT and pay for a gigantic corporate tax credit and lower the deficit, that would be good. Of course, the prices would go up at one time, and people wouldn't be too happy about that, so it won't happen.
Let's talk about where you're looking right now, because I know one of the places you're looking is small caps, which sort of hasn't yet really been working, even though everybody keeps talking about it. And even earlier, you know, we talked to Torsten Slok of Apollo, who said the problem with small caps is that they are not profitable, or at least a large proportion of them is not profitable. And if the Fed doesn't continue to really cut rates, that gives them sort of a slimmer margin for error in reaching profitability.
That's definitely true. As a whole, small caps don't borrow more money. But when we think about small caps, we have our fund is ZCAP. We don't invest in any money-losing companies.
Gotcha.
And in fact, if I was going to say one thing to investors who are just starting to invest, just follow that rule. Because it's
don't invest in companies that are losing money.
Right. Like when I was an investment banker at Morgan Stanley, we wouldn't allow them to go public. It was sort of a better day of investment banking until they were profitable. It's a while ago, but it was better days. But because then you're when you, as I mentioned, when you have profitable companies, you're stacking the deck in your favor because they invest their profits. When you don't, you're stacking it against you. And so, yes, I agree, the unprofitable portion of the small caps have not been doing well, but the best way to think about small caps are slightly cheaper value income stocks. They're a very low portion of tech. So you'll see, like when tech's doing well, small caps will be doing poorly and vice versa. And they tend to be correlated with our other funds, which are all income value funds. So we haven't done a great job of diversifying our preferred stock and other funds because they all trade together. Like they're all getting kind of smashed today.
You also have, Jay, what you call some indirect AI plays. Now, AI applies, everybody always just immediately goes to NVIDIA. What are some indirect AI plays?
Well, the easiest one, because you don't even need the AI, is all the investment banks. We focus on Goldman Sachs and Morgan Stanley. They're the biggest. They're our biggest positions in ICAP, our large cap dividend fund. But not just because of the M&A. Although this is probably the biggest change in antitrust policy ever. Because essentially you had an antitrust enforcement policy was that you can't do mergers, and now the Trump administration is likely to be very loose. So that's great, of course, for those investment banks. But there are definitely going to be AI IPOs next year, and that's going to benefit these large investment banks because they almost always, particularly Goldman Sachs and Morgan Stanley, get the lead management role, and that's, I know from being a banker, that's where you really make money. You make like half of the spread, so being a co-manager, you don't make that much. So they're really likely to have a great year.
Jay, just quickly, because I know this is something, Josh, you've been watching closely. Some of the appointments that we've seen in the Trump administration, though, it's not necessarily given that they will be anything goes on antitrust and everything gets the rubber stamp, right? So how are you thinking about that?
Well, I just think that it was so extreme. Like
that any improvement would
right,
be an improvement?
you could just pick somebody on the street and they would be way better. And you can see that in Silicon Valley, which is my hometown. If you lose half of Silicon Valley to Trump, you've done something really wrong. And you think about their business, they're okay, oh yeah, we'll pay some more taxes, they'll dodge it through capital gains, we won't mention that. But if they can't sell their companies, they can't run their businesses, they need to get realizations. So they were extremely unhappy about that antitrust enforcement. So really anyone will be dramatically better if they're just middle of the road, which they're at least going to be. So we're not so concerned about that appointment, just getting rid of the last approach, because it was the most leftist antitrust policy we've ever had in history. So as long as that's gone, it's going to be dramatically better. And like I said, we're not just focused on that. These AI, nobody seems to focus on it, but it's going to be AI IPOs, there has to be.
All right, we'll have you back soon. Talk
Great.
to you about all as
Good
we
to be on.
start to
Thank
get
you.
them. Thanks so much, Jay.
Thank you.